G'day folks, it's Jim here from Orchard Forex. It is Monday the 1st of June. Well, there's an awful lot going on in the world right now, which is making life pretty difficult for traders, as new headlines are pretty much non-stop, meaning that having a medium-term view is tricky, with risk sentiment blowing in the wind, sometimes negative, sometimes positive. But so having a long-term view is a bit tricky. And on top of the COVID-19 issues that we've got, as the world looks to get back on its feet. We've now got the US trying to set itself alight. Plenty of internal tensions in the States at the moment. We've got US-China tensions also heating up, although Trump didn't ditch the trade deal with China on Friday, as many feared he would, because of the ongoing issues over Hong Kong independence. He's postponed the G7 meeting though, and we've also got the politics of the US pulling out of the World Health Organization. We've got an OPEC meeting to contend with this week, and I'll take a look at oil in a minute. We've also got a big week of economic numbers to digest, the highlights of which will be the interest rate decisions to come from both the RBA, the ECB, and also the Bank of Canada. The global PMIs are due today and tomorrow. We've got the Australian Q1 GDP due on Wednesday. Also on Wednesday we've got the ADP figures, private employment figures in the States, which comes ahead of the official US employment data due on Friday. That won't make for pretty viewing. But ahead of all that, with all that in mind, we'll go and check out the technical outlook at a few of the pairs which seem to be interesting at the start of the week. Okay, we'll start with the euro. This is a daily chart of the euro, and you can see we've now got a bit of a double top here going back to February after the price action on Friday. The euro got up to a high of so 111.45. You can see it here better on the 4-hour charts. So it didn't finish up there. It closed a little bit lower, and right now it's trading. It's begun the week just above 111. As far as looking ahead goes, the 4-hour charts are not showing an awful lot today. The EU PMIs are going to be pretty awful. So whether there'll be much to drive the euro any higher today looks a little bit doubtful at the moment. But the dailies obviously do look positive, and if we can break above this 111.5, then I think we probably need to go back here, have a look at this level here. The 61.8% FIBO level is going to come in at around 111.60, and then we've got this high up here, which is to 112.30. Now, if we go and have a look at the weekly charts, that 112 area, let me blow this up a little bit. That 112 area coincides with the sort of 100-day moving average, which sits just above it, and this FIBO, the 23.6% FIBO level of the whole drop from last February 2018. So it's a lot. This would be significant resistance at 112, 112.30, and I'd be kind of surprised if we head above there before Friday's non-farm payroll, unless the ECB spring a surprise on Thursday. That's doubtful. So I do kind of like the euro higher, but I think the upside potential is somewhat limited, but I would prefer to be buying dips. The upside for the euro is kind of backed up too by the dollar index charts, which we'll just go and check out. Okay, so here we have a dollar index chart, and as you can see, we've had a bit of a sell-off in the last week or so. This is a daily chart. We're now below the blue line here, which is the 200-day moving average. The 100-day moving average is up here at 99. 200-day at 98.50. We're currently trading around the sort of 98.30 level, and the indicators are generally pointing south. So I do think that buying dips in the euro, selling rallies, and as far as the dollar is concerned, is probably the way to go. The weeklies, I'm just going to have a look at those. The weeklies aren't really telling us a great deal, but they may be pointing mildly low. That's why I don't think momentum is going to be all that strong. But out of a positional trade, I would prefer to buy the euro than be short it right now. If we were to get into this 112, 113 area, probably turn that around and have another think. But for the time being, buy dips below 111. Moving forward. Actually, before moving forward, I should just say that I think stop losses should be placed on the long euro positions somewhere below 110.30. But here now we've got dollar yen. Well, dollar yen is pretty much flat lining it, except for the fact that it might be building a bit of a head shoulder formation. This low down here, down around 106. Just below 106, the neckline up here, the white line at sort of 108. So if we can break through 108, the potential then is for this head and shoulders to head towards 110. Whether we get there, I'm not really quite sure. Dollar yen is so blown around by risk sentiment and safe haven demand that I'm not really sure. I'm just really pointing it out because it is a potential trade, and it might be worth buying a break of that 108, 108.10 level. But the indicators are pretty flat in the short term. Having said that, the hourlies might be building up some minor upside momentum. We are going to run into technical resistance here, though, that 108.30 level, where the 100 and 200 day moving averages are crossing. I wouldn't get too excited about this trade, but the potential is there for a bit of a squeeze higher. Moving forward to the Aussie, and as I said last week with the Aussie, we really need a definitive close above this level where we're sitting right now. We're sitting right on the 200 day moving average and on 76.4% FIBO, this drop here. If we do see a close above that, then I do think we can probably head higher towards 67 cents and possibly higher. Once again, risk sentiment plays a big part in the Aussie, and the US-China tensions are not going to do it any favours. So it could well be that we just chop around between the 100 and the 200 day moving averages. The RBA meeting is due tomorrow. I think the RBA will just say, as they've said in the past, that they'll continue to monitor the situation. If they do spring a surprise, well, the Aussie will take its direction from there. But right now, at least until, probably I think until the non-farm payrolls, when we'll see a movement in the dollar, it wouldn't surprise me to see the Aussie just chop around near current levels. The dailies are slightly positive. The weekly charts do look positive, and they're pretty much in line with stock markets. If you go and overlay a chart of the S&P on this, it's pretty much the same chart, as we'll see in a minute. But we're coming into towards the 55-week moving average here. Where's that? It's not till 67.20, so we could get up there and meet that. But like I say, I think 66.70, 75 is a pretty important area for the Aussie, and we do need a definitive close above that in order to make some progress. Much the same really applies to the Kiwi. You could possibly buy the Kiwi here around 62 cents, but we're going to run into FIBO resistance here. This is around 62.60, and then above 63 cents will be the 200 day moving average. But the dailies do look positive. The weeklies also are turning higher. We've got a bigger degree of FIBO resistance here. That's at sort of that's also at 62.60. So that's going to be a tough level to break. And until we do, I think we're probably stuck in a range of, say, 60. Where are we at the moment? 62 cents. So 61.80 to 62.60. And it wouldn't really surprise me to see that hold until later in the week, and possibly until Friday when the non-farm payrolls are released. Okay, so moving forward to the stock market, the S&P is just open for the week, pretty much in line with where it closed. The S&P actually did do as we expected last Friday. We did see a dip below 3,000, got down to 29.90, I think it was, for those who wanted to buy that dip, and closed at 30.25. It's opening a touch lower at the moment, 30.17, as you can see. Now the 4-hour charts are not really looking that positive. I guess we'll probably drift sideways until later in the day. But the dailies, they have been looking positive. They may just be topping out here, but the weeklies obviously still look pretty positive. It's difficult to retain a very positive risk sentiment given everything that's going on in the world right now. But the weeklies do point higher. So my view would be, for those who did buy the dip to 3,000 on Friday, I'd probably raise my stop loss now to pretty much break even. The 100 week moving average sits down here around the just up below 2,900. The 100 day moving average is much closer at sort of 2,950. So for those who can afford it, I'd leave my stop loss below there. We're still above the 200 day moving average at the moment at 3,000, which is kind of what we expected to support it on Friday. But unless we can really start to make a move higher, then it may be that we just do chop around. If we can get above this sort of 30.50 area, then we can head up towards the FIBO resistance seen above, well, around the 3,100 mark, and that's kind of what I've been looking for, and still continue to do so, really. So unless we do break solidly below the 100-day moving average, I still like to buy dips. But as I say, having a positive view on risk sentiment, you've really got to keep your eyes pretty tight shut at the moment. And so it may be a better way just to trade it is just to buy the dips and then take the profits as we get up to sort of this 30.50, 30.70 area if we see it up there. The Aussie stock market has, and once again it did do as we kind of thought on Friday. We saw a top up here above 5,900, and we actually traded down below 5,700 briefly. So that range that we pointed out still stands, and I'm not really 100% sure what to think here. The dailies still look positive, although they may be losing some upside momentum. But while the weeklies look good for further gains, we are going to come into resistance at this 200-week moving average here, 59.60. We have yet to get there. That top was 59.20. So we've got that, and then we've got 6,100 and 6,200 resistance. That seems a long way off at the moment, but given the look of the weeklies, I still do prefer to buy dips. Finally, keep a lookout on the oil market, which seems to be building this reverse head and shoulders. We've just opened pretty much in line with the Friday's close at 35.30. There is an OPEC meeting this week. The 100-day moving average and the 50% pivot of the whole move down are going to provide resistance. But if we do make a move above it, then the upside potential is back towards sort of the $55 area. So it's worth keeping an eye on. It's a longer term trade, not one for the day traders really. We need to hang on above the neckline here, which is sort of 32, well, yeah, 31.50, 32. But as long as we can hold above there, then the potential seems to be for quite a move higher. The weekly charts look positive, so it's going to trade in line with the stock markets, I guess. But for whatever reason, the market seems to be looking at the positives, and as I say, a move towards 55. The 100 and 200 week moving average seem to be crossing up here, so that would seem to be a target, although it's a long way off yet. But just worth keeping an eye on, as I say. So that's about it for today. I don't want to go on for too long. Happy trading, and if there's anything interesting during the week, we'll put out another video in line with that. So until then, have a good trading. Actually, before I go, I should just point out that I do a daily trend table, which is reasonably popular. So if you want to go and find out basically what I'm thinking on a daily basis, just go to the Orchard Forex site, and under the Media Watch, under the Market Watch section, here you'll find the latest daily update, and that'll take you through the trend table, and also give you some daily trading outlooks on the various products in the market which currently look interesting. So we'll leave it there for now. Have a good week, and we'll talk to you later. Cheers.